Feels like we bring up this topic a lot lately, right? Well, that's because it's a shifting landscape as policies are changed, updated, and evolved to fit and grow the EV world ahead of us. So once again, we have some fresh updates with respect to electric vehicle tax credits. Let's walk through it and see what's going on. If you're watching this before April 18th, the new rules haven't taken effect just yet. After that date, we're off and running. So what's happening here? The heart of this policy and its changes revolve around the federal tax credit for electric vehicles. It's as much as $7,500, and it's all part of the Inflation Reduction Act. How you receive that tax credit revolves around the manufacturing and assembly process of the vehicle you're looking to purchase. To qualify for any of these incentives, the final assembly of the vehicle must be in North America. To get the initial $3,750 credit, at least half the value of the battery components must be assembled here. Then there's a second $3,750 credit if critical minerals in those batteries originate in the US or amongst its free trade partners. 40% of the battery content is required to come from those countries right out of the gate. That number will rise to 80% in 2027. So right away, a large number of electric vehicles won't qualify for any tax credit since they're built outside of North America. This is why you may have noticed a large amount of production investment by a handful of automakers in recent months and years. Hyundai, Mercedes-Benz, Volkswagen, and Volvo all have fresh factories going up to help bring certain levels of production and assembly here to North America. And that's a larger goal of this plan. While there will be an initial short-term reduction in the number of vehicles that qualify for tax credits, the longer-term goal is to increase U.S. production of goods, increase jobs, and improve supply chain logistics. That's all for new cars, of course. More specifically, that's for people purchasing new EVs. There are more easily redeemable options for people interested in leasing and for folks buying used electric vehicles. There's a tax credit available for used electric vehicles that's worth up to $4,000 or 30% of the sale price, whichever is less. To snag that credit, you need to buy from a licensed car dealer and not that random person on Craigslist hawking aging Nissan Leafs. You can find plenty of good used EV deals on AutoTrader, by the way. Click that link. Also, these have to be used cars that are at least 2 years old and $25,000 or less. You have to be purchasing as an individual and not a business, and there's an income threshold of $75,000 max for singles, $112,500 for a head of household, or $150,000 for married couples filing jointly. There's a chance that if you're buying a used EV and you qualify under the income limits, you may not need a full $4,000 of tax liability. So, starting in 2024, the buyer can transfer those tax credits to the dealer, which could theoretically turn into a time of purchase discount for the buyer. And that's when the program really could get good. If you want to stay new though, and want to try and snag that whole credit amount, you could always lease your vehicle. The leased EV doesn't get hit with the same manufacturing requirements, so it could be a way around the stopping point to get both the tax credit and the specific EV you're eyeing up. Further, there are manufacturers stating that they'll pass this rebate on to the consumer, which also could lead to time of purchase discounts. So, the landscape continues to evolve, and in the short term, we're going to see the number of EVs qualifying for purchase-based tax credits drop. However, the number will soon rise as more manufacturing comes online, and that brings with it more job opportunities, better supply chain logistics, and more opportunities for folks to get into an EV if they'd previously been sitting on the fence.